Let's do a recap on existing market trends. Most developed markets' equities have been supported by strong earnings growth. The very prominent one is US, which is why the S&P keeps going up despite the Middle East war. The index's latest quarter-one earnings are the strongest in 4 years. Hence, investors favor the resilient earnings. And despite the volatility in energy markets, investors still prefer risk assets that are linked to strong macro and micro fundamentals. They're the AI-related ones, trends that are happening now. The risk now is if inflation gets so high that interest rates hikes are inevitable. For corporate bonds, especially AI-related companies, they'll likely issue more bonds to fund their capital needs for maintenance and growth. There's a lot more supply of bonds for investors to choose from. It's difficult to justify a premium, which means corporate bonds' performances might not see major upward movements, and most government bonds will likely continue to see sell-downs due to a high inflation and low confidence like you see in US, UK, Germany, and more. Optimism over AI's future and the profitable backdrops for US companies are in focus now. The equity market now is clearly led by companies in the US and Asian markets that directly benefit from AI spending. The semiconductor ones, South Korea and Taiwan. Next, European stocks will be more subdued because of the nature of most of the companies are very hardware intensive, importing and exporting a lot. And the one factor that hits them the most is high oil and energy prices. This erodes their profits. For the high spending on AI infrastructure, while some see it as a bottleneck, it's fueling semiconductor stocks. The markets right now are very concentrated in a small number of stocks, which are the AI-related companies and the beneficiaries on AI's demand boom. Let's recap why European area isn't very promising. Last year's GDP was mostly supported by resilient household consumption, which came in at almost 52%. But this time round, because of high fuel prices, many Europeans have cut down on their spendings. Corporate profits might face an impact. Private consumption won't be as good as last year's, and GDP growth might not be steady, which affects the confidence level for the euro area. So why do we care about inflation? And why do market intel companies always report all these things? Why do CNBC, Reuters, Bloomberg, FactSet, Financial Times, and more always report these timely? Inflation levels, labor, wages, consumer spending, investment market, retail sales, manufacturing and services, and net trade. Because they affect GDP and investors' confidence. And that affects government bonds. Whenever GDP growth isn't well and/or inflation is high, investors sell government bonds. That pushes government bond yields higher. Most loans take government bonds as benchmarks for pricing. So when the base lending rate goes up, loans will also be priced higher. And when GDP and investors' confidence are low, it affects currency. Weak currency and plus high loans cause spending power to drop. And when you look at everything in total, they affect this thing that investors are after. It's also something that makes the world very miserable. People lose their jobs because of this corporate profits. And that also means shareholders' equity returns and debt holders' confidence in credit ratings. This is how the market is being run. This is how each of these things are connected and drive the market, which is corporate profits. It's what investors care about. And also why these parameters are heavily studied by investment managers. From another point of view, when inflation is high and if the company has weak pricing power, for example, if it sells low premium standard products that can be easily found anywhere, it can't really pass on the newly incurred cost from inflation to its customers. In that case, some businesses will cut their workforce. High inflation affects salaries, wages. That means spending power drops, consumer spending drops, retail sales also drop. In some markets, the investment market also affects the spending power. Take China as an example. One reason for weak domestic consumption is because most people are heavily invested in real estate, and the market is far from recovering. That's why they're less willing to spend. So that's domestic effect. If other countries are also facing high inflation problems, they'll purchase lesser, and the overseas effect will affect companies at manufacturing and services, and net trade, which also means lower revenue growth and profits. High inflation also affects GDP and confidence levels. Investors will typically sell government bonds, and loans will be pushed higher. Low confidence levels affect currencies, and that means it'll hurt spending power. And when you look at everything, again, they affect corporate profits, which are equity returns, and credit ratings. Look at trends and companies instead of geographies. It's not very useful to think, is the US market good? Is Europe, China, or emerging market good? Instead, look at the trend and companies with strong pricing power, those that have direct link to consumers' current flavor. These 10 are the ones with strong pricing power. There are more companies, of course, but in these 10, you see various industries: tech, software, semiconductor, pharmaceuticals, and financials. 80%, 8 out of 10, are headquartered in the US, but all are listed in the US, and see how strong these companies' growth is. Just look at the 5-year compounded annual growth rate for revenue. Most of them are very strong. And look at the valuation metrics, EV to revenue. Typically, it's very difficult to get 5 times of revenue. But these guys are far from 5 times. Some even have double digits. And the gross and EBITDA margins are very healthy. So these are the strong one with strong fundamentals, and they all sit at the US exchange. Let's look at the recent Fed's meeting takeaway. The Fed held interest steady, no change, at a range of 3.5% to 3.75%. 9 out of 18 of the Fed officials projected that the Fed fund rate will increase by the end of this year at a median number of 3.8%. Kevin Walsh didn't provide guidance on his forecasts. He said that Fed is providing too much forward guidance, and there will be 5 task forces to overhaul Fed's way of doing things. Communication strategy to the market will be improved. Balance sheet, the data that they use, productivity and jobs, AI, and their approach to managing inflation. On to China. May's retail sales dropped first time since December 2022 at a 0.6% decline year-on-year. This is when the government scaled back trade and subsidies. Lesser discounts, fewer coupons for consumers. See how reluctant people are to spend. Fixed assets investment dropped 4.1% year-on-year. The biggest reason is real estate's drop at 16.2%. It's far from recovery. The bright spot for China is industrial profits, with a 4.5% year-on-year growth. Another bright spot is what we recently covered: China's export growth. Overall export growth in May increased 19.4% year-on-year because of the strong demand from overseas buyers on AI-related products. Exports of integrated circuits and high-tech goods all increased. That also drove China's trade surplus up. China's big problem is its weak domestic demand. Growth in China is very uneven. Manufacturing and export sectors are benefiting a lot from global trend, but the rest aren't. Enterprises are facing pressure. Many are hoping that the government will come in with policy improvements to help stabilize domestic consumption. On to Japan. Japan's central bank recently increased the interest rate by 0.25%, landing at 1% because of the weak yen and inflation picking higher. When a country's currency is very weak, there will be a lot of imported inflation because you're spending more when you import things inbound. After the hike, the Nikkei 225 increased and yen strengthened. This hike is needed and appreciated. In comments from Bank of Japan themselves, the price pass-through from the increase in crude oil prices has been progressing at a very fast pace. It's spreading from businesses to consumer prices. That's why they needed to increase the interest rate. The fast pace can be seen in May's producer price, which increased at 6.3% year-on-year, and mostly because of the high energy costs. May's export came in strong at 17% year-on-year, and it's Japan's main economic drivers. And much like China, the main reason for strong exports are AI-related products, semiconductors, and items related to AI. Exports for semiconductor surged by 61.2% year-on-year. Cars exports also increased by 16.4% year-on-year. However, some scrutinized that the volume in exports barely shifted. It increased by a small 0.5%. Much of the gains in exports were in value and not volume. This is due to prices and the weak yen. Lastly, a Strait of Hormuz update. Iran recently said that they'd shut the Strait of Hormuz because of violations in ceasefires between Israel and Lebanon. But intelligence companies are saying that the traffic at Strait of Hormuz are still flowing. Tankers continue to sail through the strait. Commercial traffic continues through. Nobody really knows who to believe, and the background is before Iran stated they shut the Strait of Hormuz. The US and Iran signed a 14-point memorandum for further positive negotiations.